Hello and welcome to this special year-ender edition, the Economy Roundtable, where we take stock of the year that tested growth, policy, markets and households alike. Now, as 2025 comes to a close, India finds itself in a unique position. Growth has stayed resilient even as the global economy grappled with uncertainty, geopolitical tensions and slowing trade. Inflation, on the other hand, has moderated, credit growth remains strong and policy choices made this year will shape the next phase of India's economic journey. Back home, the big question revolves around consumption recovery, fiscal discipline, credit growth, jobs and what lies ahead for growth and inflation in 2026. Now, to help us make better sense of everything that's changed, everything that has surprised and what truly matters going forward into the next year, we're joined by some of the sharpest economic minds in the country. I have with me in the studio Mr. Madan Sabnavis, Chief Economist at Bank of Baroda. Ms. Kanika Pasricha joins us, Chief Economic Advisor at Union Bank of India. Ms. Anita Rangan, Chief Economist at RBL Bank, and Ms. Gaura Sen Gupta, the Chief Economist at IDFC First Bank, gracing us in the studio. A warm welcome to all of you and thank you so much for being part of this roundtable, and thanks for your time today. Mr. Sabnavis, let's start with you. What, in your view, has been the biggest surprise in terms of the economy back home? It could be tariffs, it could be the front loading that the RBI had announced. What stood out to you?
In fact, I think the biggest surprise has been the GDP growth. Because when we started the financial year, there was a lot of apprehension about how growth would be affected on account of tariffs. And I think all of us had our own calculations about how GDP growth could potentially be set back on account of tariffs, because exports would get affected to the US. But today we can say with a bit of satisfaction that a lot of those fears were probably overstated. And the fact that we have done 8.2% in the second quarter is remarkable. And more importantly, I think for the financial year, I think there's general agreement that GDP growth for the year would be upwards of 7%. We at Bank of Baroda are looking at 7.4 to 7.6%. We are quite happy that RBI has also updated its forecast to 7.3%. So I think this would be the major surprise for us in India.
Okay, so that's going to be the main metric to watch out for back home. Kanika, let's come to you. How would you sum up India's macroeconomic story? We've grappled with a lot of googly balls coming in from the US, if you could call it that. Sum up this year for us. What has stood out to you? And more importantly, what is going to be important to watch out for as we head into 2026?
So, I would agree with what Madan said, that this was a year when we started the year, especially the financial year, when US-India trade-related shocks, tariff hikes, not just India, the world was grappling with the same. We all thought of a lower clip in terms of our forecast. Then, of course, we had to grapple with a delayed trade deal. Then there was an AI exuberance around the world, but India did not get as much of an opportunity. But with the front loading of exports, and I would say more important if I have to sum up this year, despite persistent global shocks, the consistency from both RBI and the government in terms of policy stimulus to address or combat the impact of those shocks has been phenomenal. That's played a bit of a role this year, though it's been a Goldilocks moment where we see higher growth, low inflation this year, which is tracking around 7.5%. In the current financial year, inflation is around 2%. Next year, we think that the delayed impact of the policy proposals may continue to show an impact. So even next year, we see growth is around 6.5–7%, bias of close to 7%, and inflation staying below 4% target for the MPC.
Okay.
So overall macro framework remains favorable. Yes, what we need to watch out for is 2–3 factors. First, how does the global economy pan out? Do we actually see a meaningful slowdown in the world, which is not yet being priced in, not being discussed as of now, because we think if not monetary policy, fiscal policy will call the shots. Will we see sustainable impact of GST-led consumption boost on growth? We think yes, but of course the numbers need close watch. Last but not the least, most important, which is something the markets are watching out for, is timing of the US-India trade deal.
Yeah, so clearly lots to watch out for. And the Goldilocks term that you used has been used by the governor in his recent speech as well. So let's see where the economy heads going ahead. But Anita, according to you, now that the front loading is done by the RBI, there is clear action on what they're going to do with the rupee, although that may play out after a certain while. What do you think the top priorities of the RBI are going to be in 2026, and which issues are they, or let's not call it issues, let's call it which topics are they going to be looking at? Is the focus going to be more on growth? Is it going to be on inflation? Is it going to be to control the fall that we're seeing in the rupee? Where do you think the core focus is going to be?
I think the core focus is going to be on the rupee. See, on growth front, I would slightly disagree, because when we see nominal GDP growth, right, that's actually less than subpar, just 8.7%. So in any terms, if you see, that's probably one of the things that will break or lead to a break in credit growth. We are already seeing 11.5%, but 8.7% is not something really to cheer about, right? In any case, and you can talk about the method in the madness, CPI revision, in whatever way. The problem it will create is on the fiscal front,
sure.
Because and we are already seeing that tax collections are not that very great. Your corporate tax, income tax, all of this is just about not meeting budget estimates for this year, at least till what we see in the November data. So that's something to worry about. And I think whatever RBI might make of its estimates of real growth, the reason why they cut 25 basis points despite of the currency pressure is that growth is weakening. And nominal growth is not something to cheer about. Even Finance Minister herself has actually said that. So that's something that we should be worried about. But currency is the bigger pressure reason, because currency can lead to inflation, macro stability, bring back a lot of pressures. And what I would say is that this currency pressure is something that we have been seeing for the last 1 year. No one expected it to go this far, because if you go back in time and see what happened last year between October to December, balance of payments, we had a 70 billion of BOP deficit, which was half of it valuation, half of it real deficit, and so on. Since then, what we saw is that your forward book went into a negative of 88 billion in February. Some of it we recovered in terms of reserves, but what we've been seeing is a steady decline in foreign currency assets. So led by gold, people generally tend to see that, your foreign currency reserves are great, 11-month cover and so on. But if you actually strip that to 2 levels below, take it to foreign currency assets, and then strip the negative forward book, it kind of comes to like 8 months and what we speak. So that's clearly something that RBI will be watching for. Of course, so 8.7% growth did need a stimulus, so they gave it, and they're giving boost of liquidity alongside, which is another critical stimulus for growth. They might do more, because from what we are seeing, they're doing 10-day VRRR and all of that,
sure,
VRR and all of that, which means that they're slowly preparing for a sustained stimulus in the economy in terms of liquidity. But I think currency will be something that we really need to watch for. Just taking a minute, I think currency is no longer about the US-India trade deal, it's more about capital flows. We have seen a steady decline in FDI flows, FPI flows as well. So it's not just about the trade deal. There is more to it that probably policymakers, RBI, will be watching for in 2026.
Okay, very well put together, and lots to watch out for. Gaura, give us your sense on what the next year holds for us in terms of the numbers that we see. Yes, the sentiment right now around the inflation and GDP numbers is positive. But what happens next year when the base starts to become unfavorable? Because inflation numbers are very low and GDP numbers are on the higher side with this 8% mark that we're looming around. What happens when the base becomes unfavorable?
So for inflation, what will happen is we will inch towards a 4% inflation next year. And even if you build in no supply shocks on food, we'll be averaging at around 4%. So going forward, we don't see any further downside risk to RBI's estimate. So RBI is indicating about a 4% inflation in the first half. For the full year also will be around 4%. In the case of growth, we feel FY27 growth will be a 7% versus a 7.6 in FY26. So our assumption is that we get a trade deal with the US, given the positive statements. The other thing to look forward to is the kind of stimulus that we have got in FY26 that has helped consumption come back. So you're seeing rural consumption, which has become a bit more broad-based. More importantly, urban, which was the weakness, has also responded to GST cuts. And I think the sustainability of the consumption recovery is going to be wage growth, which we are beginning to see. Rural already picked up. Rural wage growth already picked up since last couple of quarters. urban has now begun to pick up from Q2 onwards. And if that sustains, so we could see domestic demand, consumption-led growth that basically drives that 7%. In terms of investment, now that's the real challenge. How do you convince private sector to invest when they have so much uncertainty? So for example, as one of the panelists mentioned about the INR, and as she rightly pointed out, the depreciation pressure on the currency is an issue of capital flows. And that capital flows is not coming because the rate of return, which is, for example, nominal GDP is the rate of return. So when nominal GDP begins to slow, it shows the rate of return on your investment is actually going down in nominal terms. Though in real terms, because of inflation slowing, it's actually very strong. The thing next year is nominal GDP should pick up. We've had an 8% nominal GDP for FY26. FY27, your nominal GDP should pick up. So there could be some pickup in capital flows. But again, we'll need to see a much more sustained, broad-based improvement in company results for FPI flows to come back. We are seeing some pickup in FDI, but it's, I would say, we've not had a challenge in terms of gross inflows. That never slowed down. The issue happened for repatriation. Now, FY26, what we're seeing, the repatriation pressures come down because of the volatility in the US equity markets. In FY27, we assume the further that trend continues and maybe FDI flows pick up a bit more. But I think we need some reforms to ensure that we get back to those when we were attracting $30 to $40 billion per year in FDI inflows on a net basis for consistently for a couple of years. We need to get back to that because the stability of or I would say the pressure on the INR is because we are not getting that steady, sticky FDI inflow.
Mr. Sabnam, given that there are so many variables at play, what do you think the next policy meeting could hold in terms of commentary, the rate decision, and if there is room to cut rates further, or if it's needed at all?
So actually, let me be frank, because I always felt that a rate cut was not on the cards in December.
You said this time around as well.
There was no need to cut the rates. The reason being that there has to be some ultimate goal. And I felt that with the GDP growth being good, in fact, it turned out to be better based on the 8.2% number, and inflation continuing to be low, there was not too much of a rationale for lowering the repo rate. Now, let's assume that we lowered the repo rate because we felt that we need to stimulate growth. Then, logically, when the MPC meets in February, you will still have a low inflation number, you will still have a high growth number, you should be cutting the rate again. But the whole question is that at what point of time do you stop cutting the repo rate?
True.
Okay, so this is where the real interest rate comes into picture. While the RBI has not overtly said that they are talking of a real interest rate in mind, but they have a real interest rate in mind, their own studies show that 1.4 to 1.9% is the ideal real repo rate. So in this kind of a situation, when the repo rate was 5.5, and I think that India's inflation will be in the region of 4.5% next year, RBI is talking still of around 4%, we are well within this range of 1.5. Now, we could be running into this conundrum next year that just suppose inflation is 4.5, my repo rate is 5.25 or 5%. You'll be having a very low real repo rate. So that could actually be a challenge for the RBI because you can't possibly start increasing rates. Yeah. So I think we need to have a bit more clarity when we're talking of this repo rate. There's too much of buzz today. You cut the rate to 5% next time. Again, people will say you should reduce it to 4.75. There can be no limit to it. And we have seen very clearly that by merely lowering the interest rate, you do not make people borrow. How many of us in this particular room are buying a house because interest rates have come low? The thing is, every person, whether an individual or a corporate, knows very well that when you're taking a loan for 5 years, 10 years, whatever the period is, there will be certain phases when the interest rates are going to go up, certain phases when they'll go down. So therefore, the current repo rate or the current lending rate is not going to be the clinching factor.
But you did mention that there could be a narrow band between what the inflation is and where the repo rate is the real repo rate. What could be the way out? What could be the solution?
No, according to me, leaving the repo rate at 5.5% would have been a fair amount because you're actually maintaining that particular band. Because what's happening now is that whenever you have to lower the repo rate, you're always targeting either growth or inflation. You have never really said clearly that we're looking at a real repo rate. It's only a kind of an imputation. I'm saying it, maybe the MPC members don't believe in it. So there's nothing to say that I am right and they're not right. Sure. So when your target is basically your GDP and inflation, which is anyway being met, and it'll probably be met even in the month of April. You'll be having low inflation and high growth. So the idea of talking of a real interest rate, because we need to look at savings, because all of us are in the banking sector, we know very well that because of interest rates being lowered, there's a migration of deposits to the mutual funds, to the capital market. This creates a problem for the RBI because the moment we run into a liquidity problem, we go back to the RBI. The RBI is providing us with liquidity. So you just look at the situation. RBI is lowering the repo rate. There's good transmission taking place. The banks are crying, we're going back to the RBI. They have to bring out OA mode. You have VRR. Maybe if we did not lower the rates, we would not be having this kind of a situation.
Kanika, just to take that point forward, we've been talking about the GST and the impact that it could have on consumption. What's to say that there could not be leakages in the system where that money that is incrementally saved, there is a very, prominent assumption that it could find its way back to the consumption basket, but there could be leakages in the system where that money goes into an FD perhaps, or it goes into investment and not towards consumption. How do you think the RBI or the government are going to look at this issue?
So I would say leakages in the system. So there's a twofold impact of that GST reform in my view. And thoughts from other panelists also most welcome on this. Because see, the way it happens is that it was a twofold objective. When you cut GST rates, which were elevated for a certain period of time, it's in fact since the inception itself, what you do is, one, you create demand. That's one. Second, you're also trying to create a framework of ease of doing business because there are underlying changes being created in the reform as well. So that's exactly to plug the leakages. Now, I'll also give you one more example that, we keep talking about leakages from GST. I would say it's the other way around, because post the GST rate cut, we've actually seen before September, the credit growth numbers were also towards 10% or lower. They're not even hitting the double-digit mark. But immediately in the last fortnight of September, 1st October, we saw credit growth come back to 11.5%, and it stayed there since. Interestingly, if we take out gold loans from this credit growth number, it comes back to 10.5. Now, gold loans are a beacon of discretionary consumption in the economy. So it's actually showing, maybe GST rate cut directly is not showing an impact, maybe via other channels. But I wouldn't want to call for attention on leakages on account of GST rate cuts.
Sure.
The only concern that I have personally is that it's a very good reform. And in fact, compiling what Madan and even Anita talked about, that underlying consumption or underlying demand was weak. And of course, the shocks from global economy also leads to uncertainty, capex demand takes a beating. In that framework, the government and the RBI, specifically the government, has introduced reforms to boost demand dynamics in the economy.
Gaurav, if you would like to add on this, build to this, is this enough for the demand boost that we're seeing? Is this incremental enough to drive that? Because when we speak with managements, and particularly white good managements, your washing machines, ACs, they've all said that it's a welcome step, but it's too soon to say anything right now, and festive also has not been as good as expected for them. Now, we're penciling in somewhere around FY27 to see the impact. What's your timeline here?
So honestly, from whatever I'm seeing in the high frequency, there has been a good response. Even within bank credit, consumer-oriented loans have picked up. For example, credit card, vehicle loans, consumer durable loans have picked up. And as Kanika mentioned, bank credit has picked up. If I look at the auto sector, which has been the shining beacon of the GST cut impact, you're seeing a good, strong pickup there. I think the sustainability of consumption is income growth. If you have strong income growth, you'll spend. So what happened post-COVID is we had this sort of Goldilocks period where our income growth in the urban sector was beating inflation comfortably. In real terms, urban wage growth was growing at around 10% for a while. It started slowing down in the second half of FY24, and then we saw that weakness in urban demand in FY25. The good bit and the part which is for sustainability is from Q2 FY26 onwards. Urban wage growth in real terms has begun to pick up. We need to see a few more quarters of this. The reason why I don't think that post-COVID sort of boom that we saw in urban consumption, that may not return, because what happened is we were all working from home. There was a massive pickup in household savings. Household savings surged to 23% of GDP. It is now back to around 18% of GDP, which is pre-COVID levels. So that buffer has been used up. So going forward for FY27, we need to see a sustained pickup in wage growth, which we are beginning.
Let's shift focus and talk about one of the biggest events that we are going to be watching out for next year, and that's the union budget. Anita, expectations from the budget on the capex front or any major announcements that you're expecting to hear?
Okay, see, the budget is probably the most favorite topic for most of economists, right? Come February, January, everyone is buzzed with budget, okay? Sure. But I really want to step back and say, what happens after the budget? Budget is forgotten. That's what I want to say, because, you know, government publishes this monthly fiscal numbers, but I don't think anyone pays attention to that, right? So always, it's not about the budget. I would say please focus after that execution. What really happens on the execution front? This is where India has been deficient, okay? I'll just give you one example. So every year budget talks about big reforms, big bang reforms and all of that. A simple number, rural water spending, 70,000 crores was allocated 2 years back. It's not been utilized till date, right? Yeah. Pradhan Mantri, Surya Ghar Bijli, whatever, not been utilized. Urban housing, not been utilized. So I think this is where we need to focus. What happens after the budget? It's all very nice to say spending, you know, I focus so much. But what happens? The moment revenue slows down, spending automatically slows down. Let's look at the capex numbers, okay? Leave aside, you know, I don't think anyone focused on the 50,000 crores that was just given as an FCI loan in the first month, and people say that, oh, capex grew by 50% and all of that. Take that aside, it's only 20% growth. That too with huge amount of volatility every month. Last month with the October numbers that just came about, there was just about 35,000, 36,000 crores numbers spent. Before that it was 1.5 lakh crores. So, and that big number capex loan to state, Viksit Bharat loan that was spoken about the previous year didn't get spent. This year also there was a big number, didn't get spent. Every year, end of the year, March, we see some huge amount of number that goes and then capex number gets achieved. You know, these are the things that needs to be watched out for every month. Let's not just focus on the big bang number of the budget, but please focus on the execution month on month, what happens after the budget.
If we have a couple of minutes left, very quickly, budget wish list. Mr. Sabnabis, anything that you're looking to hear?
What I would be looking to hear is about the path of fiscal deficit, because nominal GDP has been an issue. So all the targeting which you do for revenue is normally juxtaposed with your GDP growth. So what kind of a number do you take? Last time you took a conservative number of 10%, even that seems to be low because we're getting something in the region of 8 to 9%. So I think the fiscal path is something which I think is what one would be looking for. So I think it'll be a kind of focus will be more on expenditure, because revenue, I think all the reforms have already come through. So I don't think we can expect anything on income tax or in terms of indirect taxes. So it'll be a more case of making the expenditures work better. So I'm sure if they're planned out in a systematic way throughout the year, then we'll be able to achieve the objective. And the issue which was raised by Anita is something which could be addressed.
Sure, okay. And Kanika, since government capex, of course, has a limit to it, what role do you see private capex playing going ahead? Could that be a major driver in the year to come?
See, you know, we've been hoping for the same for a long time, but a broad-based private capex recovery is missing. But I would still say one thing, that yes, whenever there are uncertain times, it's much obvious that you will not be able to see private sector come up and do a big bang capex, come up with big bang capex projects. But the government has tried to address their concern on weak demand. It will play its role in terms of boosting broad-based private capex recovery, only with a lag, and it will also depend on when the global uncertainty fades away. But I will just add one point that, you know, as a bank, what we are able to see is that at least emerging sectors like data centers, like semiconductors, renewables, we have seen capex pipeline emerge there, specifically in data centers, apart from the regular capex that on an annual basis does happen in power, steel, cement.
Got a very quick closing thoughts, your budget wish list?
I think since everybody's covered the capex side, I will cover the funding side of the budget. So next year is going to be a challenging year for the bond markets, because you have a very high redemption pressure both for center and states. So you have almost 10 trillion of bond redemptions from center and states. So that means the gross supply automatically will be much higher. So we got lucky in FY27. We had the JP Morgan bond index. So you had a fresh investor that absorbed a part of the supply. In FY26, the upward pressure in the bond yields, despite 125 basis point cut, despite 5.5 trillion of OMO purchases by the Reserve Bank of India and another 1 trillion in December, is because of that demand-supply dynamic, where the supply of bonds is more than what the market can absorb. That dynamic will become more pronounced next year unless we get a fresh investor in the market. So while everybody is also highlighting, rightfully so, that this particular, at least from the center, the focus has been on fiscal consolidation, and we feel that for FY27 that will continue. We will now move to targeting debt to GDP rather than a level of fiscal deficit, which is a good thing, which means that on an annual basis, the level of consolidation in fiscal deficit can be more moderate, and still we will achieve a reduction in debt to GDP, give space for fiscal policy to actually support growth.
Viewers, with that, it's a wrap on this edition of Economist Roundtable. It's been a great conversation. Thank you so much to Gaurak, Kanika, Anita, as well as Mr. Sabnavis for joining us in the studio. Thank you so much for your time.